All right, guys. So, while we're waiting for others to join, we're given enough time. I just like to do that so we have more inclusive webinar. Well, can I confirm that we can all see my screen? If you can confirm you can see my screen, please just leave yes in the chat section on your Zoom, just to be sure that my screen is sharing and it's very much visible to all of us. All right, Ian. Then let's get right into it. So today we're going to be talking about how to stop over trading without losing opportunities. So one of the biggest problems that a lot of traders have faced is trying to find the balance between overtrading and not missing opportunities. So this is a typical example of what it looks like and feels like. Everyone tells you, oh, you're taking too many trades. You should step away from the chart. You shouldn't, always be on your chart. Learn to leave your trades to run and all of this, advice that we get. But then at the same time, when you're trying your best as much not to overtrade, right, you realize that you're also losing opportunities. But yeah, this is one of the biggest problems that is not properly explained. So overtrading isn't as a result of having to sit in front of your charts every time. No. Overtrading comes from your inability to manage your opportunity of taking trades. So overtrading comes from having to impulsively or randomly take trades without proper execution. So a trader comes to his charts and he's trying to force the market to give him an entry. So every time he sees something, right, that looks like, mind you, looks like it is not, it only looks like and it feels like, right? It feels like he's going to be right. He decides to take the trade, not because the trade has presented him enough data. He doesn't have his requirements met. It's why it's important to have it's why it's important to have a step-by-step rule book on how you take your trades. If your trading break and retest at the 15 minutes open of the New York session or whatever, you have to have a set of rules because if you're in if you're in a chaotic environment as the market, it's the rules you create for yourself that guides you and keeps you, right? But a lot of people don't have this. So what they tend to do is they just try to play in the market. So that is when you start over trading. Because at that point in time, you're just acting as a gambler, not a trader. Okay. So that's the first major misconception that a lot of people have. So over trading isn't just because you're taking trades when you're in front of your chart. No, it's because you're taking trades relatively to your indecisions, right? You don't have proper decision making. You're just indecisive and you're going by what your emotion tells you. It feels like it's right. So now you're overtrading. Another cause of overtrading for traders would be people who are using signals. So you're in multiple signal groups, right? And then now every signal that pops on your phone, on your Telegram, right? So you're in Nelson signals group, you're in Shitu signals group, you're in, Olashe's signals group, and all of these things now, every time Nelson says buy, you're clicking buy on your phone. Every time Olashe says sell, you're selling. So Nelson, Olashe, and Shitu have all dropped three different signals. So what is that trader doing? He's taking all of the signals at the same time without proper confirmation or trying to vet if the direction of this signal is actually right or wrong, or if it aligns with his risk. You understand? Risk system. Now, when he does that, he's overtrading. But sitting in front of your screen doesn't make you overtrade. Your inability to control your emotions and your fingers from clicking that buy and sell button and your indiscipline of having a proper rule, right, that dictates your trade makes you overtrade. Another thing that can also lead to overtrading is revenge trading. The moment you take one or two losses and you just can't control yourself, you start trying to make back what you've lost. Then you start over trading because you're trying to take every possible, we wouldn't even call it opportunity, every possible um, chance at a trade that looks and feels right but isn't right. You want to take that trade, right? You create the illusion to your mind that only you can get it back, and this trade just goes well. So now you're playing game of hope, right? Not out of clarity or proper decision making, right? So let's move further. I don't think I need to introduce myself, right? So my name is Innocent Ifere Rion. I am the global market analyst and global educator here at Valetax, and I have over 7+ years, and that's an edit error. I have over 7+ years in the financial market as an analyst and a trader. Okay, but let's forget about me. Let's talk about what the topic is for today. So, most important question, like I just stated, is are you trading because there's an opportunity or because you're afraid to miss one? Or you're afraid to just sit in front of your charts and not have a trade to take? See, there's always a thin line between becoming a lazy trader and becoming a patient trader. And there's also a thin line becoming an impulsive trader, right? And becoming a patient trader. So here's the trick to it. I personally can sit in front of my chart and not take a trade. For some people, it's impossible. It's like every time I come to the chart, I have to take a trade. But I'm not going to take a trade if I come to the chart if it doesn't fit or meet my required entry criteria or market condition. So if I come to the chart and the markets are extremely rapid and moving too fast with no headway, no direction, just long spikes on the market, and I can't seem to make headway of the trend, I'm not trading. If I come to the chart and I look at the chart and I have set out, an expected entry that is supposed to meet up and I don't find that entry, I'm not taking the trade. What that does is it's a discipline that has helped me not to always try to take a trade every time on the screen. But at the same time, it made me feel like I'm losing opportunities. Now, truth be told, you then have to conceptualize what an opportunity is to you. Is an opportunity every time you didn't get a chance to enter a trade and make profit? Is that what we refer to as an opportunity? Or is an opportunity an expected or a further future probability of market reacting in a certain way or respecting a certain outlined rules of a strategy and opportunity? I'll say that again. Is an opportunity just every time you fail to take a trade that you thought would have been a good trade and you didn't make profit from the chart? Is that your definition of an opportunity? Or is an opportunity a defined rule in terms of your strategy, market condition, and everything you set in place? A future speculated you know, expectancy or opportunity. Yes, for a lack of better term, let's repeat the word opportunity. Is that what we're going to define as your opportunity? So you need to find on what side of the pendulum exactly you're on. Okay. Now, that being said, if your definition of an opportunity is the first one, then you're always going to suffer. You're going to have a problem. But if your definition of an opportunity is something that is determined by a criteria, by a step-by-step factor that needs to judge if that is an opportunity, then you're already making headway. It's the reason why some traders can tell you all week they haven't had an opportunity, not because the market stopped moving, not because other people weren't making profit, not because a million other people weren't taking trades, but because what they've set for themselves as a discipline didn't come true. Your ability, yeah, pardon my use of this case scenario, right? Your ability to walk into a group of people who are taking alcohol, right? When you can also take alcohol and say, no, I'm not taking alcohol. I do not want to take alcohol today. Not because you don't normally take alcohol, but because you've said to yourself that I have a busy day. It's a Sunday. I'm at a party. It's a Sunday, and I have to get to work as early as 8 a.m. tomorrow. If I take alcohol, I would probably not be able to get to work early. That's your discipline. That's a structure you put in place for yourself. You just told yourself that if I take alcohol, I won't get to work early, and work is more important. Doesn't mean other people are not drinking. Doesn't mean other people don't have work to go to on Monday, but something differentiates you from them. It's the same way opportunities are always available in the market. But what defines your own opportunity as a trader is dependent on the rules you set for yourself. So overtrading doesn't come by sitting on the chart. It comes by you just taking every random case or signal or analysis or whatever, or you're trying to force the market to give you something that is not. That's where overtrading comes from. And some people will tell you, oh, I've been overtrading my whole life and I've been making profits, blah, 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 blah. Well, that's on them because they could overtrade for 3 months and be successful and overtrade for 1 month and destroy everything they thought was success because at the end of the day, flukes would always show themselves up. Okay, so we have to define what that opportunity is. So some people are just afraid that they are going to lose out on a moving trade and say, "Oh, I missed an opportunity." It wasn't really an opportunity if it wasn't really an opportunity if there wasn't anything defining what made it an opportunity. So even when people say opportunity comes but once, the reason why you can't see the opportunity is because you never defined it as an opportunity. If you define what an opportunity is, you would see opportunities every time. Okay, so let's not take that mentality of opportunity comes but once. No, opportunity comes where you've defined what they are supposed to look like, or when you put yourself in places for them to meet you. And where you put yourself is in front of your chart after you've defined what they're meant to look like, especially when it comes to the context of trading. Okay, so why do traders overtrade? Like I said earlier on, loss of emotional control. The moment your logic is overridden by your emotions, right? You've lost already. You've played yourself 2-0 up front, handicap, and you lost, right? The fear of missing out. The reason why people also overtrade is that fear of missing out. It was never really an opportunity. It wasn't your opportunity because you never had a defined criteria that made it an opportunity. You just came and saw the market moving. So all of a sudden, you want to jump into the trade. So now you're overtrading. Now you're trying to force a trade. Because if you had a criterion for how your trade should move, then you would understood that that wasn't an opportunity for you because it didn't meet the necessary requirements for it to be referred to as an opportunity. Now, the next thing, like I also said, is there's no clear process. You don't have a rule, you don't have a set by set, factor that determines when you enter a trade or when you leave a trade. So, what decides what an opportunity is for you? That's a major concern. So, it's not just about I trade ICT, I trade smart money. No. Even within the ICT and the smart money concepts, there's something called a proof of entry. So what's your proof of entry? Are you waiting for prices to shift in structure, create a possible change of character, a return to order block? Where exactly is it? Are you bold enough to sit on your hands until prices return to that order block before you take the trade? If prices never return to the order block, are you okay with letting the trade go? So these are the things that make people think they miss opportunities. You didn't miss the opportunity. You had a criterion. It was about you staying disciplined with that trade, right? A couple of people in my community might think that, oh, for a couple of while, Rion hasn't called enough trades, in my personal community, right? Rion hasn't called enough trades. People I trade with are like, oh, where's Rion? Rion's gone missing. No, there's just a lot going on for me at this point in time that hasn't left my concentration to be on my charts 247. So if for any reason that I decide to trade without full concentration, it means that I would be lacking in something. I'm not paying attention to my trades. I can't give full updates to my trades. All right. So where does that put me? That puts me as a bad trader because I have people who are trading with me and I should be responsible for feeding them that update. And if I can't, that's indiscipline and very uncultured of me. So I would rather not. And I'm also trading my personal account, meaning that I'm going to be putting my account in harm's way, which is wrong. Okay. So these are the things that you think about when you talk of over trading and opportunity. So I may not be seeing all the opportunities because right now I'm not focused to see the criterions to actually say, oh, I missed an opportunity. I'm not waiting for any of those things. So opportunities are existing in the market every day for people to take, but it's not just my opportunity. So you need to figure out what your opportunity is. What are the process, to you entering a trade? Then you can then say, I missed an opportunity or I didn't miss an opportunity. If prices respected everything that sits in your rule book, then you can say you missed an opportunity. Now, what are the hidden costs of overtrading? This shouldn't even be a thing of question, but the financial cost, the number of times you're going to lose more money, power to the number of times you're going to make more money. The ratio is going to be incredibly terrible because every time you overtrade, there's a likelihood that you're going to close that trade out in loss because you did not plan the trade. So every drawdown, every slip is going to make you panic and you're going to close the trade. So when you look at someone that has a dirty trading history, it's usually as a result of overtrading. Now, here are two things that we need to pay attention to. Not just the dirty trading history, but because when you tell people a dirty trading history, they confuse it sometimes. If you're a multiple position person like me, I could take GBP JPY, for instance. Yeah, that's the pound yen. I could take the pound yen and open um 10, 12 positions on the pound yen. So instead of opening 10 lots on the pound yen, I could go 0.95, 0.95, 0.95, 0.95 in 10 positions. Why I'm doing 0.95, 0.95, 10 positions is probably I have short TPs ahead. So my plan is to execute, take three, a chunk of three, and then still probably limit the positions and close, half of my lot sizes and leave them running, or whatever the case may be. They're different people, right? So things like that could also cause your P&L or your trade history, right, to look a bit messy. But then there are people you see taking different trades, or they are entering the trades at different times. I hope we're following and I hope it's making sense. So when you're opening those trades in different times, right? So you took a trade at 10:02, you closed it at 10:15, you took another trade at 10:17, you closed it at 10:18, or you closed it at 10:30. We can clearly see that there's a discoherence between your trades. So I know you're overtrading. But if I open your trading history and I see that you've opened 10 positions, the timing would tell me that this was one trade. So you took one trade, but in different positions. But where you're taking different trades, right? At different times. Now I know that you're overtrading. So that's going to cost you even more. Now, it's also going to cost you a poor risk to reward trades because at that point in time, you're not acting out of clarity, right? If you're not acting out of clarity, what you're simply doing is you're just jumping in and out. So you're not calculating your risk to reward any longer. It doesn't matter. You've thrown it out the window completely. So you're just entering and you're just setting stop loss that seems fit. You forget it. And I'm very sure each and every one of us on this webinar tonight has experienced this. You tell yourself, oh, you're going to take a 1:3 risk to reward trades. But somehow you find yourself taking trades that you didn't even calculate them, right? You just took the trade because it looked good, because someone said it was a good trade, and you totally forgot to calculate your risk to reward. You just took the stop loss. So that when that happens, you lose that, you lose that balance and that margin. The next thing is the emotional cost. When you start over trading, you get stressed out because now you're not making any profits. You're taking too many trades. You probably take 10 trades, and out of 10 trades, you make only you profit on only two trades. But guess what? Because your risk to reward is already terrible, the two trades you take are not even profitable enough to cover up for two losses. So you've lost $10, $10, $20, $30, $40, and then the trades you took that actually made profits, you made only $5 and $8. You see how you see how the game is scrambled already against you. So because you've completely forgot your risk to reward and there's no process, there's no rule, completely out the window. The next thing is your performance cost. Sometimes a losing streak can weigh you down to the point where you start to even question yourself. So even when you finally start to see good trades, you question them. How sure am I this time around I am right? And you see one of the biggest things you don't want to face, right, as a trader is where you get to a point of self-doubt. The moment you ask yourself, is this trade even right? Am I sure I know what I'm doing? That's one of the biggest pitfalls you want to fall into as a trader because you might stay there for a very long time where you would have good analysis that meet every criterion that you have, every opportunity, but you can't take them. Now, that is where you actually start to miss out on the opportunities because when you're supposed to execute, you're questioning yourself. And your one of the greatest edges you're going to have as a trader is your ability to execute regardless of how you feel. But because you're so stressed, you're frustrated, you're burnt out, your emotions are on the higher side than your logic is. So you're responding entirely to your emotional quotient, not your intellectual quotient. So when that happens, you start to question yourself. So you start to perform lower quality decisions and you have inconsistent results. Are we following? If you're following and you're understanding, please just leave something in the chat section. Just say I'm following, or just let me know how far you're following and if you're enjoying the session so far. Okay. So now, how do professionals avoid overtrading? So one way to actually do this is, like I said, have your core principles that guide you as a trader. What's your entry requirement? What's your exit requirement? What makes you take profit? When does the market become sketchy? What are the things you see in the market that tells you, oh, I think it's time for me to lean away from this trade. Sometimes I could be in a trade and I'm looking at the trade and I'm like, you know what? I'm not going to wait for TP on this trade. Prices are starting to slow down aggressively. There's too much consolidation at this resistance. You don't want them out. You need to have those things. The same way you need to have what terms your entry, right? So you need to understand that. Now, another thing you can also do, even with that, is you need to ask yourself if the market structure is clear. Personally, for me, if market structure isn't clear, I'm not trading. If I can't see a very clean market structure, I'm not trading. So when I'm thinking market structure, I'm thinking this now, this is personally, right? From my trading plan, how I look at it. Am I at a key level? Am I above or am I below a key level? Am I looking at momentum to break a key level or to hold a key level? Do I have a confirmation? Does everything about my entry, right? Does everything about my entry align with my trading plan? So if I don't have a confirmation, it doesn't fit my trading plan, I'm not trading. It's hard. It can be hard sometimes. But I'll give you a secret. One of the ways to avoid overtrading as well is making sure that your whole source of livelihood doesn't come from trading. Because if your whole source of livelihood and your life is completely tied and built around trading. Now, when I'm saying your life is completely built and tied around trading, right? I'm not trying to say don't be a trader. That's not what I'm saying. I'm saying have other things you do, have hobbies. Do you like to go to the gym? Do you like to watch comedy? Do you like to read a book? Have something else you do. Because when everything you think and want to do is just click the buy and sell button, you've just somehow, right, trapped yourself. Because that's what, entirely the market wants you to think of yourself. You have to click a buy and sell button every time. No, you don't have to. You can't perform as that many actions and that many decisions in a day. I think psychologists have it to say at the end of the day, as human beings, we can only make about 7 to 12 accurate decisions out of utmost clarity in a day. So how many can you make if you're trying to buy and sell every time? So you need to have something that balances your life outside of trading. So either you have a side hustle, you have a side job, or or you like to you have a hobby, you like to go play basketball, or you do something that allows you that when you come to the chart and you can't see what makes sense to you, you can say, you know what? I'm out. And you go play basketball or you go do something else or you go watch a movie or you go read a book. But basically, have something outside the charts itself. I know a lot of people wouldn't tell you this. They'll tell you, oh, spend enough time with your chart. Yes, have dedicated time where you're on the chart and you're learning. But in those periods, you and I know that when you want to learn, right, you need to shut your brain off from trying to trade. You're just looking at the charts. If you're trying to forward test, fine and good, do it during a live market. If you want to learn, back test, study the charts over the weekend, right? So have dedicated time for those. But the times where your central nervous system is telling you you need to trade, and you come to the charts and you don't see that thing, you should be able to pull your central nervous system back into reality and say, there's no trade here for me. So I'm going to use my time to go do something else. The reason why a lot of people fall victim of overtrading is a lot of times new traders don't have any other thing to do. All they think about is trading, 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 trading. So even if you want to think trading, 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 I think you should think trading, read the book, read Trade Like a Pro, read the disciplined trader, read a book about trading, go online, watch the news, what's happening on Bloomberg, what's happening in the world economy. Those are all parts of trading. So when you don't see a setup, you can still do all of those things. And guess what? You're building yourself, you're enriching yourself, you're becoming an even better trader. You don't have to click the buy and sell button every time. When you want to click the buy and sell button, click the buy and sell button because it does make sense to click it, not because you feel like clicking it, not because you're pressured into trying to make quick bucks from the market, right? If you choose to do that, well, that's on you at the end of the day. But if you want to do it the right way, you need to discipline yourself to know when to buy and when to sell, not just because the market is bullish or bearish, but because there's an opportunity that you have defined as an opportunity to take the trade. And if you're not going to be trading by yourself, then make sure you're taking the most minimal amount of signals and expert advice from wherever your expert advisors are, right? You don't have, even if I personally, right, in my personal community calls, send out 10 different analysis. I don't expect everyone to take all 10 of it, right? I expect that you should be able to vet, look, and see, and then calculate what your total daily risk, allowance is, and see, okay, if this trade, if my allowance allows me to take 3 to 4 trades, that's good. That's all I'm going to stick to. I look at the trades and I look at what's best for my account size, what is fast, what is medium paced, and what works, right? That's how you should think as a trader. You need to become more logical than more emotional. Okay. Now, this is another important part that I need us to understand, right? Missing trades, all right, are part of trading. Some people feel like once they miss a trade, that's the end. They're never going to make that money. And that's why they FOMO. That's why they rush into the trade and end up losing. Because one thing a lot of people don't understand about FOMO is this. When you miss your initial entry, that gave you your best risk to reward ratio. It gave you the best risk parameters that you could set for yourself. It gave you, in fact, the best opportunity to manage your risk. The moment you try to chase the market, remember you're chasing the market that's already moving. So one of the key things you're going to notice is your stop loss becomes higher. You're not giving the market, even if you decide not to use your original stop loss, you're going to be trying to put safer stop losses, thereby not giving the market enough space to breathe. So any small drawdown or pullback that the market does, it takes you out of the trade. So now you're getting angry that the market keeps kicking you out. And eventually what happens? Your emotions start to get what? Start to get spiraled. Now you're getting angry. You're getting pissed off. The market is playing with you. And then what's the next thing your emotion tells you? It tells you take another entry. Now you're taking another entry. You're not giving the market enough space because you're trying to, manage your risk. And then it keeps kicking you out. And then guess what happens? Now you're over trading. Now you're trying to catch the trade. You're trying to enter the trade again. The next thing you realize you're doing, you're doubling down because you've lost so much small, small pennies and now you're trying to make them back on the next trade. So you start doubling down. And these things we're saying, I'm not telling you because it is common to just a few people. No, it is a human psychological response to when we feel like what we think we know how to do, we are losing at it. Think about it this way. I'm sure we watch football. Have you noticed the frustration on a player's face that had practiced 2, 3 days before the match, right? And had scored goals during that practice match in the same format, the same pattern, the same style, and finally gets on the pitch and has 3 shots in his pocket and loses all 3 shots. Do you imagine the frustration on his face? Now, try to remember what their next reaction is on the pitch. They get frustrated. Now, sometimes they lose focus and they are not even able to push a ball into the net again because they've lost it emotionally. The same thing happens to us as traders. When you lose one, two, three for something that you're sure you literally made profits. You've taken this trade before and you've made profits. Now you've lost one, two, three, four, 5 times. Your head starts to go crazy. Your emotions are on the high. The moment that happens to you, if you can't control it and you can't contain it, then you start overtrading. You're doubling down. Before you know, you've lost total control of your logic. Now you're just emotionally trading and you're going to end up losing a lot. It's going to cost you. All right. So here are a few things that professionals know. Opportunities never stop coming. Opportunities doesn't come but once. It comes as much as it can for as long as you have a rule that dictates what those opportunities look like. And it's the market, for God's sake. Over 12 trillion traded daily. There's no way you're going to miss an opportunity if you have the right set. And if you miss an opportunity today, you can't miss an opportunity for a whole month. Except, of course, if you're a swing trader like me, right? If you're a swing trader like me, you can wait 1, 2 weeks for an analysis to set up. If I miss it, if I miss an opportunity, I know that my next opportunity might take a while before it comes, right? So, except you're like that, you don't really have to be so stressed. As a day trader, especially, opportunities would come. In fact, even I, as a swing trader, I just need to scan a couple other peers and I will definitely find an opportunity, right? Now, markets will be open tomorrow, of course. Capital preservation comes first, protecting your capital. Now, it doesn't necessarily have to be your trading account. You could have your capital stored in your broker's wallet, probably 10,000. And then when you want to trade, you pull out 1,000 and then you're trading 1,000. So you're still protecting your capital. But at the end of the day, even the account you're trading, you need to treat it as such. A missed opportunity is better than a terrible loss on a trade. And I need you to understand that. Never forget that. It was one of the things that I had to learn the hard way. I would rather miss a trade than take a loss on a trade because I'm trying to chase it. But I would rather lose on a trade, right, that meets my requirements, my factors, everything. I would rather take that trade and lose on that trade than not execute. Can you see the difference? I would rather not trade, right, than lose on a trade I'm trying to chase. But I would rather execute and lose a trade on trades that meet my requirements and I term them as my opportunity than to miss it. So as long as it fits, I'm executing. In fact, I have a personal rule. 75% is execution for me. I don't need 100% matchup to my criteria for my entries. 75%. If I get my key level, if I get my discount, and if I get my imbalance or whatever after that pullback, I'm entering the trade. I'm setting my stop loss right below the previous protected low or high, and I'm good to go. I don't need to wait for a candlestick. I don't need to wait for a pattern to form. I usually use patterns, right? But it's not every time. Sometimes I would want to wait for a double bottom pattern to form or something that just shows a direction, a candlestick pattern. But 75% is good for me because at the end of the day, 80% of your trading is execution and management. If you can execute and you can manage, you're good to go. But sometimes when you've taken those losses and you start to question yourself, those doubts start to cripple in. That is when you start to negotiate your own trade. So something that you know fits well, you're negotiating it. So there's no negotiation, just execution and management for as long as it fits your entry requirement. Okay. Missing a trade would definitely hurt your ego. Definitely. But you need, that's why it's your ego, right? The ego is almost the downfall of every man. So that's why you need to manage your ego and don't let your ego, run you. You should run your ego. Okay. Taking a bad trade also would hurt your account. Very much well. We know that. But you would rather take a well-calculated trade and a well-calculated trade that fits your criteria and execute regardless, right? I know you lost on a trade that you have a proven record or show for, right? That it is highly sustainable. Okay. So here are my final takeaway for us before we start. If you have questions, please start to leave your questions in the chat section. Okay. So I'll answer your questions right after. So my final takeaway for us is to stop overtrading, you need to focus on quality over quantity, right? Focus on trades that you see that have the best risk to reward, the ones that fit your criteria, the ones that also matches your time and place at that particular period in time. Okay. Follow a checklist before every trade. Like I told you, I have a checklist. 75% is execution worthy for me. I don't need to get 100%. 75% is execution worthy for me. And why 75% is execution worthy for me is because I personally have tested it that, okay, if out of 10 trades, right, 70, every time I take a trade on 75%, right, my reward ratio is 6 to 4. And because my risk to reward is fair enough that when I lose 4 trades, my six would always topple and cover it. I'm good to go. So if I'm running a 1:4 risk to reward ratio, if I lose 4 trades, right, I've lost only 4. But I've also made what? On the six that I've made 4 times 6, that's 20. So that keeps me 16 ahead, right? So that allows me to run a 75%. Okay. Then be patient enough to wait for your edge. I can't overemphasize this. Sitting in front of the chart every day is not a bad thing. But sitting on your hands while on the chart and knowing when to buy and when to sell is the most important thing. And then number two, remember, the goal is not to trade more. The goal is to trade better. And from something, remember, everybody is still learning, right? Everybody is still learning, and you're always going to keep learning. The times where one of the major issues, right, that even professionals have is that they tend to forget sometimes and want to be right instead of wanting to just make money. And you can also fall in that cycle. The goal is for you to make money. The goal is for you to build cash from trading. So always remember the goal is for you to trade better and the goal is for you to make more cash. All right. So do we have questions? I'm taking questions now. Questions. Hit me with your questions, guys. Can we have those questions coming in? Okay, so while you're waiting for your questions, I'm just going to show you guys, I'm just going to show you an instance, right? So let's take this is AUD USD, right? I expected AUD USD to play the standard break of the bearish flag, and the retest, not necessarily to the flag, but to the previous key area, which was this level here, right? And prices never came back into this area. Just right after the FOMC projections yesterday, we had this huge dump. Prices didn't get to this area. But did prices do come into a level? Yes, it did. It did come into this week at this level here before selling off, right? But it didn't come into my expected region because I felt like prices should, move into this area. And this is what matches my criteria, right? Now, this would have been a feeling that, this says, yeah, I'll just, let me just take the trade here. But it wasn't given that, it wasn't given that 75% for me. This was my key level. I still had more space here. Yes, I had my liquidity sweep to happen here, but I wanted to get a proper sweep and then back down into this level, not weeks. It doesn't count for me. It didn't meet my 75%. So there was no opportunity for me to have taken the trade. But did it sell off? Yes, it did. I'll show you um I'll show you my XAU USD, right? Now, XAU USD, this was a valid point for me to sell from, but I didn't sell from here, right? These sells were short sells. You can see some short sells at this point here. This one was clean scalp that I took. I think this was on Monday. Yeah, I took this sells on Monday and I was out straight to my TP. I think even lower. I came as low as this at this point here, and I was out. I took this sells to here and then I was out too. But I was still expecting prices to have pushed in a bit higher before the continuation of the sells happen. Does it mean that the sells were wrong? No. Does it mean I was wrong? No. At the end of the day, it just didn't meet my criteria and I didn't take it. So what's happening now? Now I can now reevaluate. Now I can see that the previous bullish character was what has been taken out. This internal bullish character has been taken out. So what would I be expecting? That prices would do what? Come back in and retest. And it had done exactly that. And it has continued the trend selling. Now, if we can successfully break this other structure here on the bearish side, I can now confirm the bearish trend has begun. Now I can wait for opportunities to what? To re-enter this trade and continue the sells down. You see? So my ability to be fluid, but understanding that opportunities would always present themselves. So what would be the opportunity I'm looking for now? I would want to see another break of structure here. This isn't a clean break of structure. We can see the candlestick rejecting. So waiting to see how today's candle closes. If we can close below here, then I would be expecting a sweep of this New York highs here. This was the New York opening here, right? I would expect to see prices. I would expect to see Asian session sweep this New York highs, right? Or London tomorrow sweep this New York highs before I re-enter this trade. And I'll continue for the shorts. So it's just having what is important to you and how you want to take the trade that helps you stay away from overtrading. But guess what? When I come back and I look at, so you can see even on another chart, you can clearly see that, my expectancy has always been this level. It didn't get here. We had gotten here, I would execute with with lightning speed and fire, right? Now, the XY clearly met my expectations. Break retest at this level and continuation. Hence why um gold didn't get to that level as well. I expected that the DXY would have been a bit slower, right? So I'm looking for GBP USD. God bless you. Now this is GBP USD. You can see clearly how GBP USD respected my entry criteria. I wanted prices to come back to this level and do what? Sell off from this level. I gave it enough room space with my stop loss to allow the market have its room to play whatever game it wanted to play, right? So if you draw this, you'd see that it came back like for some sort of retest. And that's why I had my stop loss where above my last protected high. Can you see here? My stop loss was here. So this played out cleanly and I executed. You get, so basically why I'm showing you this is so that you understand that it's not about how many times or how long you sit in front of the chart. It's about having the necessary things that defines an opportunity for you. And if you miss it, fine and good. The market will present itself another opportunity. Okay. So in light of no questions, I am believing that we have no questions whatsoever. And I want to believe that we've enjoyed the session so far. If you were following through on the session and you enjoyed the session, please just leave a thumbs up in the chat section for me. Let me be sure that we were following on this webinar and you enjoyed the webinar. All right, then. And thank you so much for joining the webinar. If you're yet to open an account with Valetax and you're new to Valetax, please do not forget to go to www.valetax.com. Go to a member area and register to get yourself an account. You can start trading with as low as just $1 deposit. We have one of the best ECN accounts in the trading industry. In fact, the best ECN account with as low as just $50 first time deposit, whereas other brokers would charge you higher than that, maybe 1,500 or 500 to just get an ECN account. At just $50, you can get an ECN account with as high as 1 to 2,000 1 to 2,000 on leverage sizing, right? Which allows you to, to maximize your opportunities on your account. So feel free to please go to valetax.com, get yourself registered, and start trading with Valetax. Trade smart and trade safely, most importantly. And we also have a lot of education materials on our YouTube that you can consume at every point in time. And make sure to also join in on Mondays on Valor Talks, where you are sitting in a round table of professionals with over 30 plus years experience in the market, traders who have been trading since 1994 and the early 2000s. There's no there's no black swan event that they haven't noticed or they haven't experienced, right? So you want to also learn from those people and also learn how they execute in the market. And until next time, I'll see you on another webinar in 2 weeks' time from Valetax, and I'll still be your host, Rion Ifere. Have a good night, guys, and cheers.